The following podcast was recorded on Thursday, August 14th, 2025, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
So today, Jim is going to be discussing, is tariff inflation coming? And Jim, CPI came in largely in line with expectations. PPI, much hotter than expected. This renews the debate. Will tariffs cause inflation? Tell us about the size and scope of tariffs.
Yeah, so as we answer that question, let's start with the basics. So let's go to the first chart that we have, and it shows you the yearly average of tariffs going back to the 20th century, so about 120 years of data. Blue line is the actual numbers. The red line is now, under the way we're working it now, we update it daily, and it shows you the highest tariff rate and the lowest tariff rate for the year. And you can see that red spike is unlike anything we've seen in the last 100 years when it comes to tariffs. They're very slow and predictable. They don't gyrate around wildly like some kind of cryptocurrency. If we go to the next chart shows in red that same thing you were looking at before, just it's all smashed together in a 100-year chart. This is the red is the average tariff rate. Now, to be clear for those that are a little wonky, it takes the 2024 volumes of trade and assumes that doesn't change because of tariffs, and then it just gives you the weighted average tariff on the 2024 volumes of trade. Now there's others that say no, those volumes will change because of tariffs, and then they put algorithms together to try and change it, but we're just going with the simple method of what was it last year. And so right now we're looking at an average tariff rate of around 18.6%. When Trump was one-upping the Chinese and we got to 145% around Liberation Day in early April, we got to a 28% number before they backed off. Now the blue line on the chart, that shows the tariffs collected. So that, you know, this is the marginal rate that we're charging. But what about what we're actually collecting? And that is, so what this number takes is how much did they collect in tariffs, and I'll show that in the next chart, divided by how much trade did we get in a month. So right now, the average tariff rate is up to about 10%, but it keeps rising every month, and it will probably keep going up. And over a long period of time, just like the beginning of the chart, the blue line and the red line, the marginal tariff rate and the average tariffs collected were converged on top of each other. Eventually, over time, this will converge on each other. And that gets us to our final chart on the size and scope of tariffs. This shows how much the Treasury is collecting in tariffs, or they call them customs and duties to be more specific. Now, the gray shaded area and the dotted line show you the average and the standard deviation. For those that got a C in statistics, that just means 2/3 of the readings are within the shaded area before Liberation Day, and it averaged 5.95 billion, called $6 billion. And then you can see the big spike in the tariffs that are being collected, which is now on average 10. And as I wrote on the chart, the excess above the pre-Liberation Day average is $76.5 billion of extra tariffs have been collected in the 4 months since April. That works out to about $306 billion extra of tariffs per year. And that number is probably going to go higher. Who is paying it? And that's really what we want to talk about in the next couple of sections. Who is going to wind up paying this tariff?
Are foreigners going to be footing the bill?
Well, the answer is, if we go to the next chart, I'll give you the T's. They were for a while, but they're not anymore. So this chart here shows Japanese passenger car exports. So the Bank of Japan puts together a price index of how much Japanese cars that are being exported to, in blue, the United States, in orange, everywhere but, or North America to be more specific, in orange, everywhere but the United States or North America, and in red, everyone else. Now, this chart's gotten a lot of play because it's dove down, and I indexed it to 0 on March 31st, 2 days before Liberation Day. So it's down about 19%, meaning that the Japanese car makers that export cars to the United States or to North America have cut their prices by 19%. President Trump, Treasury Secretary Besson have said, look, this is evidence. They're going to cut their prices, so we could then slap the tariff on top of that, and then, you know, the final consumer is not going to have to pay it. And they use this chart as an example. Now, the orange line shows you the Japanese car exports, excuse me, to the rest of the world. Their prices have hardly moved. They're down 0.5%, and that's probably seasonal because of the time of year. But in red, I think is more interesting. That is all cars in general, and it's only down 4%. In other words, what that tries to tell you is that red line doesn't look like the blue line. In other words, they don't export a lot of cars to the United States. There's a lot of Japanese cars in the United States, but they're made here. You know, the Toyota Sienna minivan is made in Indiana, for one example. It's not made in Japan and shipped here. So even though that is a number that we've seen fall a lot and people have pointed to it, it's not a very big number. Furthermore, last month, a lot of the media reporting was that this number was cut in the immediate aftermath of Liberation Day, that the Japanese exporters, car exporters, didn't know what to do. They wanted to protect market share. Now that they're getting the lay of the land, they're going to start raising these prices again. And so this was a temporary thing. So if we go to the next chart, it shows all imported prices by country. Are anybody cutting their prices? And they're all indexed to March 31st at 0. So you can see all the charts converge at 0 on March 31st, and you can see what they did before March 31st and then after. Well, some are up, some are down. Canada's down the most, but this is all imports. It also includes crude oil, which has slumped a lot. We get a lot of crude oil from Canada, and wood products and the like. But the bottom line is you're seeing maybe a 1% movement on import prices. In other words, exporting countries cutting their prices when we've seen 18% tariffs from 2% tariffs. So what this chart is suggesting in the previous one is largely no, the export countries are not cutting their prices to eat the tariffs. They might have, in the case of passenger cars, for a little while they were sorting things out, but that's reversing.
Well, how about companies? Are they eating the tariffs?
It's not evident that they are. So if we go to the next chart here shows you S&P 500 revenues by quarter. So, you know, or total sales. This is the year-over-year change. So the orange line is the second quarter, which was just completed. And these companies are growing at around 8% a year. Now, keep in mind, when we're talking about S&P 500 companies, we're talking about north of $20 trillion of sales for all 500 companies. And we're talking about a growth rate of around 8%. That's what they have reported through the end of the second quarter, because about 95% of the companies have reported. That's a really good number. It's above nominal GDP, which is around 5% or so. The third quarter is in gray, and the fourth quarter is in black. And you can see that those numbers are starting to move up too, that the second quarter earnings revenue numbers were so strong that Wall Street is upping its third and fourth quarter revenues. So from the revenue standpoint, what companies have reported, there's no signs of a slowdown or margin squeeze or anything. If we go to the next chart, the next chart shows you company offered guidance. So this is just a diffusion. Company had a number out there. They said we're going to earn $2 a share. Then they come out and they up it, or they update it, and they say we're going to earn 205. That gets a +1, or it's going to earn 195. That gets a -1. And so this shows you the net of guidance. It has jumped to the highest number in 4 years. This is not Wall Street. This is companies telling us their outlook looks really good. This is not companies saying in total that they're getting squeezed by margins. All right, maybe Apple says they're getting a squeeze because of the iPhone, but in general, they're not. And then the final chart is a Citibank offer chart on the earnings revision index. So this is Wall Street's estimates. This is Wall Street's estimates, and then how much they get revised. Now, typically what happens is Wall Street starts with, I will initiate my 2026 number for earnings on company X, and it's a big number. And then they spend the next 6 months downgrading it. They always overguess and then have to downgrade. And you can see that's why you see far more red bars on this chart than blue bars in this chart. Blue bars are very rare. The last 3 weeks, we have blue bars, first time in 2 years. So in other words, what this is saying that the expectations by companies, the revenues by companies is so strong that even the overguessed Wall Street estimates are starting to have to be raised, not lowered. So in sum, is corporate America, that $300 billion of tariffs, are they getting squeezed by it? No, I don't think they are.
So you touched on foreigners, you've touched on corporations, but what about the consumer?
I think all roads lead to the consumer, unfortunately. So let's go to the next chart, the fourth section. This comes from Price Stats. This is Alberto Cavello over at Harvard University. He was the original creator of what was called the Billion Prices project. It has been sold to State Street Bank and it's now called Price Stats. And they look at online prices of 5 large retailers, including online retailers, including the largest online retailer, Amazon. And so they track literally millions of prices and they update it every day. So I pulled out of this two measures. Imported items on online retailers subject to tariffs, and also imported and domestic items as well too in blue. So you can see that there's definitely a movement in tariffs because the orange line is going up. As it's written on the chart, the orange line is going up by an annualized rate of nearly 4.5%, 4.48%. What is not shown is a subsection of that orange chart, which would be the Chinese originated products. They're going up by almost 7%. So you're starting to see goods prices moving higher, and this is a daily update. So if we jump to the next chart here shows you CPI broken down 3 different ways. By food and energy, so-called core inflation in green, by food only in orange, and by goods prices in blue. The CPI core is 3.1%. That is a big number. As I've pointed out in other places, when was the last time the Fed cut rates when core inflation was above 3%? The answer is last year. It was above 3% then. And the response by the bond market was not very good. The bond market, saw the 10-year yield go from 3.6 to 4.8% in 4 months. In other words, I would be arguing it was rejecting those rate cuts as a mistake. Before that, the last time the Fed cut rates when we had 3% or higher core inflation was 1990 to 91 during the Gulf War. Now we had 5% core inflation and they were cutting rates, but that was because the price of crude oil went from $17 to $40 and everybody was panicking. We were going to have a depression because we were going to have this war in Iraq and it was going to lead to $100 crude oil and no one would be able to afford gasoline and everything. It didn't turn out to be the case, thankfully, but that's why the Fed, it was a special circumstance that the Fed was cutting rates out of a panic. Before that was the 87 crash, another special circumstance, panicking over a depression. Before that was 1985. So there's no real example in the last 40 years of the Fed cutting rates above 3% inflation and it turning out to be a good thing. Last year it didn't work. In 90 and in 87, those cases were special circumstances where we were panicking about a depression. So if the Fed's going to cut rates, it's going to be something that's going to be wholly unusual. Now I want to focus on the blue line. And the blue line I want to focus on here is goods prices. A year ago, goods prices were falling at minus 1.9%. Now they're rising at 1.1%. So the rate of change in goods prices is higher, kind of like the price stats chart before. Goods prices are always the blue line, other than the 2022 period when we had to squeeze because of the COVID reopening. They're always lower and they're always holding down core inflation. If goods prices are on the move up, so is inflation. It's going to be on the move up as well too. So if we jump to the next chart, the next chart shows you PPI. PPI numbers came out today. They were not good. Core PPI, that's final demand less food and energy, producer prices, business pays, jumped 0.9%. Huge shock. There's only been 4 other instances in the last 15 years it's jumped higher, and that was 21 and 22 when inflation was on its way to 9%. So this was a gigantic jump. Now, a lot of economists and wonky types that look at this data could say, here's the 80 things wrong with PPI, and you know what? I agree with about 75 of them. There's a lot of issues with the PPI number. But what isn't an issue is my final chart here. And this comes from Guy Labas over at Gianni Montgomery Scott. He puts together an estimate, like a lot of people on Wall Street, he puts together an estimate of core PCE after PPI comes out. And he breaks it out really nice. Now, core PCE, personal consumption expenditures, that is the preferred metric for the Fed. That's what they like to look at for inflation, not CPI. Core PCE uses the same survey that PPI and CPI use. They just have different weightings, and some of the PPI categories are in PCE. So once you get all the readings from CPI and PPI, reweight them to core PCE, add that up, and as he shows in the bottom, we're looking at a monster number coming at us at the end of the month for core PCE, 0.56. Maybe it's a 0.5, maybe it's a 0.6, but typically they're not off by more than a tenth one way or the other. That's huge, and that's the last Fed preferred inflation number before they cut rates in September. So they're about to cut rates with the worst inflation number that we've seen since we were all breathing into a paper bag about inflation 3 years ago. Further, if you look at services ex shelter, that is super core. That is Jay Powell's invention. That's his secret sauce that tells him whether or not we're going to have an inflation problem. That's 0.7. Man, that is a big, big problem normally for Powell. Now, a week from today, he speaks at Jackson Hole. We don't know exactly when. They haven't released a schedule. They only release it about a day or two before he speaks. But this is going to be the issue he's going to have to talk about. You're about to cut rates, or are you about to cut rates, Jay? Are you going to cut rates or aren't you going to cut rates? And if you're going to cut rates, these are the metrics you told us to watch. And these metrics, when they were lower, you told us we can't cut rates. Now that they've blown out to huge numbers, you're now telling us you are going to cut rates, or are you not going to cut rates? Because it looks like all this tariff inflation is starting to come. Why didn't we see it in April, May, and June? 2 reasons. Some of the foreigners cut prices to maintain market share for a while, and they're raising it. Probably more importantly, April, May, and June, the stuff on the shelves was stuff that was imported before Liberation Day, and it wasn't subject to a tariff. Then when you get into July, August, September, October, and onward, the stuff on shelves is going to be tariff stuff, and that's going to have a higher price. I think we're starting to see that with goods prices going up, the price of stats numbers going up, the core PCE number being problematic. So the Fed's got, Jay Powell's got a lot of explaining to do. Why are you finally now waiting until everything is going wrong with the inflation numbers, in my opinion, to then start cutting rates? Or are you going to push back and say, no, we're not going to cut rates? And then President Trump will pull out the analysis they did of the building renovation and find something that is unseemly or untawdry and look to fire you for cause. So it's going to be exciting at the end of August, excuse me, the other month that starts with A, and we'll have to see what comes, because that speech is going to be interesting whichever way he goes. Are you going to make the case to cut rates with these inflation numbers? Please, I'm all ears, explain it to me. Or are you going to push back, and then I'll go to the True Social account and wait for all the choice truths to come out about Jay Powell. He's been a numbskull and a moron and too late before he pushed back, if he winds up pushing back. So we'll see what happens if he does next week.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Have a great day.